You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionFit.com.
All right, everybody, welcome back to the Option Block, everyone's favorite bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call around here, the Options Insider Radio Network. Baker's dozen worth of programs on the old network, including, good grief, 450 archived hours of the Option Block. Where can you find all that goodness stretching well into the thousands of hours for the full network, including interviews and analysis and unusual activity and education and advisor-oriented stuff and futures or options-oriented stuff and unusual activity-oriented stuff and all of the above? Well, of course, you can find it on the mothership, the flagship, theoptionsinsider.com. Surf on over there. Kick the tires and light the fires, as they say, and you're off to the races. Of course, you can also find it iTunes, Stitcher, Aha, Mobile, TuneIn, pretty much anywhere you find your favorite leading audio and podcasts, or, of course, just grab our mobile app, available for iOS, Android, and, indeed, the Fire OS. And joining me on the old program today, that stalwart from the suburbs, Uncle Mike, from RCM Wealth Advisor / RCM Future / RCM Alternative / RCM MISC. Uncle Mike, welcome back to the program, sir.
Always happy to be here representing RCM MISC.
It's my favorite branch of the ever-expanding RCM empire.
Hey, when someone tells me what it is, I'll be happy to let you know.
All right. And with the team mostly assembled, we're going to dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. As the name implies, this is the portion of the show where we break down what was moving, what was shaking, what was lighting up the old tape today. And as we are recording this on Thursday, May 28th. I gave us a month back in the year, Mike. May 28th here, playing the home game. Those of you at home like to follow along. There you go. There's the date. But we know a lot of you guys come in weeks, if months, if not years after the fact. And we welcome all of you guys as well. There's a lot of education, analysis, and just witty banter that is just timeless on a program like this. And as we talking about moving and shaking today wasn't really a day full of moving and shaking, more of perhaps slight ripples. Most of the major indices pretty much unched on the day or down fractionally on the day. Nothing really big to speak of. The SPOO's off two handles, so there you go. That was our day pretty much in a nutshell. Volatility ticking up a little bit into the approaching weekend, which is interesting. Of course, we have this shortened holiday week here in the trading markets in the U.S. VIX cash in the 13 handle range, up to about 13.5 or so today. A lot of things we can point out here that caught our eye amidst this kind of relatively quiet day. We still are in the teeth, or I should say the tail end of earnings season. But before we get into all that fun stuff, Uncle Mike, what caught your eye in today's activity, sir?
Well, today mainly really didn't catch my eye too much as yesterday did. So I guess it's kind of like whenever you go out fishing with your friends and they have a great fishing day yesterday, they say, oh, you should come out fishing with us. We had a great day today. Okay. And then they always say to you when you get into the boat, oh, you should have been here yesterday. And that's kind of how I feel today. We had kind of a boring day today. Not too boring, but not a lot of action. But man, you should have been here yesterday, option block. We should have done the show on Wednesday just because there was a lot more excitement. I think that today appears to be kind of the market kind of taking a little bit of a nap, so to speak, from all the excitement that went on. And by excitement, I mean some type of movement that went on Tuesday and Wednesday. We had a lot of down movement on Tuesday, and then we got most of it back yesterday. And today it was kind of boring. So not too much catching my eye in the market world. Just to see a little bit of up movement, a little bit of down movement in stocks, bonds, as well as the commodity world. So today, not a lot, but overall this week, it's been pretty interesting.
Yeah, those are the perils of having a bi-weekly show. From time to time, you're going to miss the crazy moves, and you're going to come in on the days that are a little bit more lackluster. But that's all right. We don't mind looking back. We have a long gaze here on this program, Uncle Mike. So it's not just today's activity, but sometimes yesterday or this week's and other things that caught our eye. Speaking of things that are catching our eye and a lot of people's eyes out there in the marketplace, I think we'll start with a name that we wouldn't normally discuss. It's probably more notable for its absence than anything else, the absence of our product anyway. It's, of course, a Shake Shack. This is the name that if you've been watching this one, IPO'd, I think, around 21. It just not looked back pretty much all year. Got up to, I believe, the mid-90 handle. Let's see, yes, $96, almost $97 it got to at one point. Has since been kind of on the tail end of that slide. Has dropped about 20 handles or so since then, trading today right around $76 and change. And normally that's an ideal scenario. People saying, hey, we got all this huge run up in the underlying. I want to buy me some of them, our puts. And yet a lot of people asking, why can't we do that in Shake Shack yet? It's been out for a while. What's the deal? And so a lot of people came out today and have been discussing this week why there are no options on Shake Shack. And they even went to the SIBO and asked them over there, I believe it's our friends at Barron's. They said, why can't people trade options on this thing? And SIBO came out. We've had a discussion on the show before, back when the Viceroy was on here, about the myriad requirements that are necessary for a name to have listed options. And in the case of Shake Shack, it just doesn't meet the float. It needs about 7 million, and it's only got about 5.75 million. So it just doesn't meet enough float to really be a viable options listing prospect. That said, there is some hope for all of you out there who are holding Shake Shack and for whatever reason don't want to sell it, but you still are concerned about some downside. If you can grit your teeth until July, at the end of July, actually, so you got another 2 months and change to hold on. Who knows, a lot could happen given what's happened just in the past few weeks. But if you can grit your teeth and hold on until then the float there's a lockup that ends then, and then some more shares should become available, and then it should be eligible for listing. So if you can wait 2 months and change, you can buy your puts. I don't know. What would you do in this scenario, Uncle Mike? Would you, if you were concerned, you probably just dump it, right?
I'd put in a stop loss. I mean, there's an argument. The age-old argument of a put option versus a stop loss. The put option costs money. The stop loss, you risk a gap. That's the bottom line of the argument. In this case, you don't really have much of a choice. So if I was holding it, and if I was holding it since 20, the first thing I would do is smile. And then the second thing I would do is just probably put on like a trailing stop, a stop loss, or something along those lines to protect myself. And the other thing that I would do is I would at least have sold a portion of it by now if I had held it that long.
Yeah, you got to take some of that skin off the table there and out of the game, because that's a decent run from 20 all the way to 96, and you got to hope you had a little bit of common sense somewhere along the way to at least pair off some of that, so that you're not staring at a massive loser. But that said, if you are one of the myriad out there in the retail masses who have jumped into Shake Shack with both feet, stay tuned for a little while longer, and I don't think Uncle Mike's advice is bad at all. If you are worried, of course, you can work that stop. Doesn't really help you in some of those aggressive gap scenarios. That's where the put comes in. But still, it'll at least get you out somewhere, hopefully around where you're working that stop order. Speaking of the other side of the fence, is one of my favorite names, even though I don't trade as much anymore. Used to trade it a lot back in the day when it was a wee bit cheaper than it is today. This is the Stealth Apple, a.k.a. Chipotle, ticker symbol CMG, of course. Closing today about $630 even, $630 even, up about 3% or nearly $18 on the day, and a lot of that love coming from yet another analyst upgrade out here. Analysts just loving themselves some tinfoil wrapped burritos. I think it was Miller Tabak today who bestowed the love upon the stealth apple here. They said their price target was $7.15. Now, lo and behold, it's $10 higher to $7.25. And when you raise your price target $10, that's of course good for an $18 bump in the stock. Does that make sense to you, Mike?
Well, of course. I mean, it's going to go up another $10, so you got to buy it by all means.
Got to have it. You got to drive it up at least 3% to get that extra $10 that's coming down your way.
Absolutely.
Either way, stock was up about 3% today, or about 17 and a half handles. This name just lighting it up today, doing about 2.5x ADV out there for an options volume. They're doing about 10,000 a day, usually doing about 27 almost thousand today. So lighten it up today from an options perspective. And as you might expect, given the somewhat one-natured tone of the underlying today, the options kind of echoed that. Not as much as you might guess. Only about 1.5 to 1 calls over puts. It wasn't 2.5 or 3.5, something like that you might normally see on a day like today. Actually, a lot of people here, are still buying some puts, lifting offers on puts and other things. People perhaps thinking this is getting a little bit overdone. Either way, still a lot of options action, and of course the majority on the call side. So not everybody perhaps thinking things are getting a wee bit heavy. Certainly not Miller Tabak, who thinks they got another almost 100 handles to go in this name. So good stuff. Of course, a lot of people also focusing on good old Goog today. They're not lighting it up yet, but people are poising for them to light it up soon. So Uncle Mike talking about all the things we missed. We're going to miss their big Google I.O. presentations going into the end of this week and the weekend. So if you're watching Goog, pay attention to that. Today was literally unched on the day. Everyone kind of keeping their powder dry, doing light options volume. But they usually have a lot of big announcements coming out of this event. It's kind of like their Apple Developers Conference for the year. So stay tuned for that one. See if perhaps we'll get some Google action on Friday, maybe going into the weekend. Speaking of tech stuff here, this stat caught my eye, Uncle Mike, and it kind of intrigued me. I was on the SIBO floor back in the height of the go-go 90s, the dot-com burst and bubble and all that fun stuff. So I remember the explosion of M&A that was going on out there in that realm, and it hit its peak in, not its peak, because its peak came in 2000, but its penultimate peak, you could say, in 1999 with about $227 billion worth of tech-related M&A. And looking at the numbers, it hit about 385 the following year. Then, as you might expect, fell off a cliff in 2001. Got down to about 50 billion in 2002 and kind of vacillated around there for a long time. This year, so far, we're perhaps on pace to challenge that number for the first time since 1999, with so far this year, tech-related M&A about $110 billion, and they project, if it continues at this pace that it has so far this year, they're expecting about a $273 billion M&A year, which would dramatically exceed what we saw in 1999. So there you go, Uncle Mike. Proof positive we are back in a bubble. What do you say to that, sir?
Happy days are here again. Everything's good. Honey, the market's back. Let's start buying some stocks now. I think that, you raise a good point with that, or raise a good statistic with that, and with the M&A activity that's going on. And so I think that with what's going on right now in the M&A world, I think it's another bullish sign. And one of the reasons that I'm the bull that I am is because the whole world is so bearish right now. And this is it's said all the time in the financial news media, this has been the most hated rally in market history. And I continue to be a bull.
You are indeed, sir. Not so much a bull on Apple, but still a bull on SPY. Let us know when you're right in those heavy calls to the upside in SPY, too, so we know we can get out there as well. When you're done with all your bullish sentiment, then you know the worm has truly turned, sir. So keep us posted on that. Meanwhile, it's time for us to keep on rolling right on into our next segment. It's time to dive on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Everybody, welcome to the Odd Block. This is indeed the portion of the program where we break down the weird, the wild, the wondrous, sometimes just downright head-scratching paper that is lighting up the old ticker tape today. Going to kick things off, not surprisingly, given the movement we've seen out there of late in the energy realm. In particular, this is CONSOL Energy Inc., ticker symbol CNX. Closing today about 28.5, down a little bit more than a buck, or about 3.5% on the day. So not a banner day for CNX from a underlying movement perspective. Certainly a banner day from a volume perspective. Doing about 7,600 contracts a day. So this is a fairly robust name. Doing about 13,000 today. So fairly aggressive. And the lion's share of that differential, over about 5,400 contracts or so, come in pretty much on one mega call buy, particularly for this name. It was the July 30s that caught our eye, June 30s that caught our eye today. They went up when we started profiling them this morning. Block of 4,606 went up, paper buy-in for 54 cents. As the day continued, that total went up to about 5,400 and change on the day. The latter part of those probably for a little bit better price because these options went out, as you might expect, a little bit cheaper, 47 cents at 51 cents. Now, it's not exactly probably a straight up buy because there is 5,040 contracts open interest on this strike. So it does look like perhaps our friend here is deciding to take his short calls off the table here. There's no other leg to this. He's not rolling to reestablish or anything like that. He's really just saying, I kind of got a little lucky today, got a little close to the fire, and then the stock came off, and so I'm just going to take my opportunity to close the book on this one and perhaps play the wait and see game when I want to open up here again. Uncle Mike, what does this trade mean to you, sir? What does this speak to you here in the dark heart of your soul? Would you concur this guy is just probably looking to take this off after taking the opportunity in the underlying and not really, probably just kind of wiping his brow saying, "Ooh, that was a close one," and not really looking to reestablish?
The dark heart of my soul, huh? Well, anyway, you never cease to amaze me of your way with words, Mr. Longo.
That's what you get when you wire me up and put me on a mic, sir.
That is it. What I would say to this trade is, if I was in this situation, I would say it is Miller time, and I am not talking about the beer. I am talking about Steve Miller. Take the money and run. Sometimes those short calls can, especially if it's not part of a spread, or if it gets a little bit too close for comfort, whether it's a short call or a short put for that matter. If you're just trading the call or the put itself, if it's just that along with no other spread, that's something to where you have to be a lot more careful than if you have a spread on a lot of times. So that's what it would appear to me as well. And you can always get back in.
Yeah, exactly. And looks like our friend here is playing it close to the vest, saying, yeah, I'm going to let this thing maybe retrace a little bit and probably pick my levels again next time a little bit more judiciously before I take them off. This is probably, I know a lot of our covered call traders we profile here on the show, they roll the second the thing gets anywhere even near the strike. So the fact this guy got within 50 cents of his strike, he must have been sweating profusely, even though I've said many times, not the worst thing if you're a covered call writer, and we probably assume this guy is. All right, moving on to a wee bit larger name, a name you may have heard of, Mike, and all of the listeners out there. You probably might hit it on, who knows, maybe a daily basis, particularly if you have little ones. I'm talking about Mickey D's ticker symbol, Mickey D, MCD. Closing today, $96 and about 50 cents, off about 1.5% on the day or so. It's the name that, as you might expect, does a wee bit of volume, averaging about 45,000 contracts a day. Doing a little bit more than that today, doing about 48,000. So it wasn't the net volume that caught our eye, or even the gross volume so much, as it was a particular spread therein that attracted us to this one. Here we are. I'm going to pull it up for us here. There we go. So far down, I have to scroll. There it is. It is, of course, it came in June. It was the June par, so 100, 105 call spread going up. When we started profiling, actually looks like about the same paper, about 9,000 times total, going up in 2 blocks on the ISC, of course, marked as spread, as you might imagine. Looks like paper buy-in, so they were buying the pars, selling the 105s for a net debit of 48 cents. It went up, like I said, we talked about 9,000. Some other scattered contracts went up. A total of 9,500 by 9,200. Now, what's interesting about this is there's some size on this strike. About 32,000 open on the pars. About 105. The strike has about 45,000 calls open. So some serious paper. Looks like about 47,000 of the 97 halves open as well. So I wonder if there was perhaps some funky fly or something went up there on some funky three-legged spread went up on those strikes. Either way, he wasn't playing on the 97 half, so it was all pars and 105s as he came in to buy back about 9,000 and change of those. If this is in fact our friend closing, and it does appear to be the case, and he still got over 20,000 of these things to go. So pay attention to this one, listeners, because there might be some interesting stuff afoot. Also, about nearly 2,000 of the June 95 puts going up. Also, 17,000 of those as well. So perhaps instead of being related to the 97 halves, those calls, that call spread could have been financed by some 95 puts. And he's taking those off the table. 17,000 open on that strike as well. So there's a few strikes where some people have been playing for some decent size. What's your take, Uncle Mike, as he once again plumbed the depths of your unusual activity soul here? You think our friend is closing? You think he's piling on for some more upside love in Mickey D's? What's your take here? And what's your take about Mickey D's as well? Is this a holding you have in the Uncle Mike portfolio?
Minor holding. My feeling on McDonald's, I think it's arguably the best company in the world and also arguably the worst food in the world. We live in the Chicago area, so if I ever have the opportunity to go to Portillo's, I would never, ever subject my family, myself, or anyone for that matter to McDonald's if there's a Portillo's nearby.
Yeah, but Portillo's doesn't have the cool Happy Meal toys, and good luck convincing the little guys about that. At least that's the problem I have.
That's when I lay down the iron fist. I'm not going to eat McDonald's just for that. I'm a pretty nice dad in most areas, and my kids have asked on many occasions, why don't we go to McDonald's? And my response is always because their food tastes like garbage. We're going to Portillo's,
sir,
kids.
The dark heart of your soul. There it is.
Yes, but it's a great company. I love McDonald's as a company. They're an ingenious business. But I would say this would be closing paper, because if you look at the June 105 call itself, I'm just looking at it right now. It's at 8 cents by 13 cents. So, and that's based on the close of the market today. So I'd have a hard time of anyone. I have a hard time believing anyone would be buying something that far out of the money, and I would have an even harder time believing that someone would want to sell something that far out of the money. So I would say this is most likely closing paper as well, in that McDonald's did have a down day today. If you look at it just from a daily chart, pretty much right at the open, they opened it around the 98 level, and they pretty much went straight down all day. So I think this looks like just someone closing some positions out.
I have to say, I concur with you, sir, but there are some weird sizable strikes open out here. Like I said, the 97 halves on the calls, the 95 puts, even 97 half puts, also sizable, about 14,000 open of those. So there has been some interesting paper afoot out here, all the way down 13,000 of the June 75 puts. I wonder when those were put on at a penny for those. So yeah, a lot of interesting paper, as you might imagine, with a name that does as much volume as good old Mickey D's. And since we're talking about names that do volume, let's wrap it up with the name that does perhaps some of the most volume, certainly on the underlying perspective. This one is sometimes the exchange product leader by volume on any given day, at least from the underlying ETF shares perspective. This is, of course, our old friend, the much loved / much maligned VXX, closing today $18, I guess, in this name. Some of these ETFs, VIX's points. The other ones are not dollars, but 18.88 here, up about 1% or so on the day. This is the name that does, as you might imagine, some decent options volume, about nearly 250,000, about 230,000 contracts a day. Doing slightly less than that, doing about 170,000 today, so off about 60,000 contracts. So that wasn't what caught our eye, the sheer volume of it, as much as one interesting trade, and you can pick a few, as you might imagine, amongst the sea of paper out here. But what caught our eye in particular were some fairly longer term puts. In particular, there were two sizable put trades out here today. We'll start with the first one that we saw that really caught our eye and was clearly opening. This was the Jan 2017 7 puts going up. Looks like paper buying for 40 cents, going up 12,500 times, and that's pretty much it for the day. Went up in several blocks, split up on the SIBO, on the Amex, so that's how you know it was, floor traded, facilitated paper, and we see things going up on the SIBO, on the Amex. Those are the two places that still kind of specialize in the large, what they call complex, high-touch type execution. Interestingly enough, this is interesting in and of itself, but we also saw a little bit closer to home about 13,000 of the Jan 2016 10 puts going up over against 40,000 contracts open interest. So it is possible our friend out here is perhaps closing some of those Jan 10 puts, and which is an interesting time to do it, and then rolling out a year farther and 3 handles south to the 7 handle to say, hey, I'm going to load up some of these. Mark and I were joking on, I think the VolView show recently about how these ETFs, a lot of these things just have this natural decay built into them, and if you just load up on far off puts, it's almost a done deal that you're going to be looking for this thing to do all right. This product in general on a given year can lose about half of its value for all the reasons we've described before, roll yield coming back to haunt it and things like that. So if you're a believer in that, then you might be a believer in these puts. Interesting that this guy's choosing so far out to go here, and perhaps rolling if that is indeed the case. Also some size puts open here on the Jan 2017 15 strike, about 100,000. Those bad boys open as well. So some people playing a little bit closer to the fire there, and those will certainly probably come into play pretty soon. Interesting stuff. Uncle Mike, we talked about VXX before. What's your overall view on this much maligned VIX ETP, as well as our friend out here? You think he's rolling? Think he's just opening up, and those two trades are unrelated? What's your take here, sir?
It seems like it would be a roll of some sort, just based on the fact that you have a 13,000 lot and a 12,500 lot set up like that. I like the idea of it, quite honestly. If I was into the VXX and the VIX world, I'd probably look into doing something along these lines. I just based on all like what we've talked about on the show a lot, I just have a hard time being bullish on anything VXX related. And then whenever I have clients calling me and saying, yeah, in my other account, I bought some puts on VXX. And so that's typically when I have a good long conversation, or I bought some calls on VXX because I'm bullish on the VIX. And so it's usually when I have a good long conversation and then end the conversation with Mark Sebastian's phone number. So I think that on here, I really, for this kind of size, now I know we've established on this show many times that the big money isn't necessarily the smart money, but in this case, I think it's just someone that's trying to do something that's long-term bearish, and I kind of like it.
Yeah, I can't really argue with this guy. I'm looking here back at some of our earlier unusual activity. We actually profiled that buyer of those Jan 2017 15 puts back in January. He paid $2.95 for those at the time. I don't recall if all this open interest was that one trade, but certainly a decent amount was. And now, like I said, they're $3.70 at $3.85. So our friend here up nearly a buck already on, if these are all his, 100,000 puts. So he's smiling and laughing all the way to the bank on these. And it's one of those trades that you kind of got to scratch your head at and say, why aren't more people doing this? Because it's a wasting asset, however you carve it up. And they come up and admit it pretty much straightforward. I think UVXY is the one we were talking about on Volatility Views. That's the one that just had the reverse split to get itself back up to put on its big boy pants again. But if you watch, it's going to inevitably decay over time as well. And we saw some deep puts going up out there as well, or far out of the money puts. So interesting stuff afoot out there in these volatility ETPs. If you're one of these ones who buys in, and why wouldn't you, to the fact that these things do decay aggressively over time, then it may be an interesting trade in one of your longer-term portfolios, your retirement accounts, other things like that, where you could leg into some of these types of trades, and maybe you spread it off so you don't take all that premium risk, and then you see how things roll from there. Speaking of things rolling, it's time for us to keep on rolling right on into our next segment. It's time to dive on into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, welcome to the Mail Block. This is indeed the portion of the program where we break down all the questions and the comments and the insights that you guys send in to us here on the old show. No shortage of ways for you guys to do just that. Hit us up on the website, theoptionsinsider.com. Click on the feedback form link there, or just leave us a comment. That'll all get to us. A lot of you guys like to use the web comment form, so go for it if that is indeed your choice. Of course, you can find us the old-fashioned way, questions at theoptionsinsider.com, or via social media, twitter.com/options, facebook.com/theoptionsinsider, and StockTwits, easy for me to say, .com/optionsinsider. All right, going to kick things off with a question from Mr. Gerry E. We actually touched on this a little bit on vol views, Uncle Mike, but you weren't on there, and I wanted to get your input on this one as well. You're kind of the token technical an analyst, for lack of a better term, on our show. And that's saying something on our network when no one else really wants to touch him. You're kind of by default the guy. He writes, "Hola, fellows." Hello, Mr. Gerry. He goes on to write, "Like the program, especially option block and volatility views. I notice you guys don't talk much about technicals. The few times you have mentioned them, you seem to take a dim view of them. Why is that? Why are there no technicals? Are there no technicals that you feel are useful for options traders to pay attention to?" Easy for me to read today. And yeah, this one I kind of, like I said, kind of hit on vol views, but really quickly, I think the reason I've taken such a dim view on them on this show, as I've mentioned before, is we used to scalp a lot of stock back on the floor of the CBOE to pay for our long premium positions and to hedge our short gamma. So you're doing a lot of gamma scalping. In fact, that was the lion's share of your profits many days, is scalping that gamma. So you put a lot of work and effort into analyzing the underlying from a fundamental perspective and everything else, and of course from a technical perspective. And when you do that a lot and you try all these different systems, and all the guys around me in the pit were trying all kinds of different things to work their scalps, none of them worked. None of the different systems worked. The only ones that really seemed to have any traction were the really low-hanging fruit things like Fibonacci and Bollinger, and the things anyone could look up on Yahoo or on a quick Bloomberg search and just kind of type it in. And you could see, and the only reason those would even work, in quotes, is because there'd be a large amount of orders in the book at those levels because everyone was working them. So that kind of really broke me of a lot of my faith in technicals, and I kind of, really, I've joked here many times on the show that you could have a banana and egg indicator. It doesn't matter what the hell the indicator is or if it's at all related to the markets. As long as people believe in it and they do it, that's what matters. And so you could have the most unrelated thing in the world. It's going to be raining on a Tuesday, therefore sell stocks. If people buy into that, it's going to work. So, or at least have some orders coalescing around those levels in the book that you could reliably perhaps hedge against or trade against. So that kind of broke me of my love of technicals. But there, I've already said too much. Uncle Mike, you're the one technical fan here. Tell us what your view is on technicals and what you've seen at all that really applies to options trading.
Well, I like it how I'm the one that's the big technical analysis guy here, just because of the fact that I would say maybe in making a decision on a trade, I would say maybe 5% of my analysis would be technical analysis, so to speak.
But the fact that you do any makes you our token technical guy.
That's kind of how it is, I guess. So when it works, hey, I'll be the technical genius. But if not, well, I only do like a little bit of it. So I'm not really a technical guy now, but I'm really not too much. For the most part, my thought on technicals, what I actually do look at, I look at a streaming chart during the day, but it's just more to actually see what's going on as opposed to really making much of a decision. The things that I'll look at during the day would be what the open of the market was today, as well as what the close was the day before. So let's just say, in theory, SPY closed yesterday or the day before, whatever it would be, at 210, and today it gapped down to 209. And so now that's not what it did today. I'm just kind of using this as an example. What I'll do is I'll just put like a line on the chart at those two levels. And I do think that those are key numbers, because when it goes above 209, that means that it's up on the day, even though it's down from the gap. It is up on the day's trading. And then 210 is the open of the day. I think that's kind of a key number as well, because if the market doesn't go through those numbers, then it's not going to be up on the day. It's mathematically impossible to do so. The other things with which I'll look at, I've mentioned on the show the 2120 level in the SPX for I don't even know how long. That's just because of the fact that it's a new all-time high. It's not a technical indicator or anything like that. It's not Fibonacci, it's not stochastics, it's not RSI, it's not mean regression. It's none of that. It's just a number. And I don't know if you necessarily call that technical or not, but what I like to do is use specific numbers as like lines in the sand. Very seldom I might break out a 200-day moving average or a Fibonacci retracement, but that is very, 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 very seldom I would actually look at something like that, just because of the fact that anything can happen. It's a new day. There's a lot of things out there, and like you say, Mark, the technical indicators aren't necessarily it doesn't necessarily mean it's going to happen that way. And I've seen many people blow out on technicals, and so it's not a big thing. I'm not necessarily a chartist, but I do look at key numbers, which I do feel are an important factor in making a trade.
Yeah, I think you can make an argument for those psychological support and resistance levels because they certainly exist. The even numbers where everyone works their orders, and certainly there are impacts of those levels. But yeah, beyond that, you'd be amazed how many different systems have been pitched over the years here, Mike. And this one works. Buy the stock here. Why should I buy the stock there? Well, because the green triangle points up. But why does the green triangle points up? Because it's pointing up. It's just madness. So yeah, I've been pitched a lot of systems. I've yet to see the one that does the job, but if you're out there and you have some system that you found and it works for you and it's making money for you, hey, ignore us. Do what works for you. But just in my long experience and Uncle Mike's experience, it hasn't been the biggest driver of revenue, shall we say, and just leave it at that. All right, let's move up. Another question here. This one is from the user, goes up with the handle. Nice one. I like it. Calls versus puts. And I don't think he wants either of them. He writes, why isn't there just one product that you can sell and buy to express your bullish or bearish outlook instead of two, calls and puts? Isn't that a bit overkill? So apparently, well, there is one, Mr. Call versus puts, or Mrs., I shouldn't assume. It sounds like you want the future, or indeed the stock, if you're talking about a stock, because that's what you can do. You can just buy it or sell it to express your bullish or bearish opinion. That's the whole purpose of those Delta One type products, the futures and the stock, is that they just do that. You can ride them up, ride them down, sell them, short them, buy them. That's about it. Very relatively simplistic from an execution standpoint. When you get into the options, you're right. It gives you a lot more choices. I think he's kind of maybe he's hearkening back to the good old days. A lot of people maybe not remember this, but in the early days of options, in the 70s into I believe the early 80s, they pretty much just had calls. So the whole thing was all calls all the time. So people said, why would you want to sell something? You just want to buy. And if everyone wanted to just express bullish opinions and then in turn sell those bullish opinions that they didn't have it or didn't share it. And then a few people realized, I think actually it was Ivers Riley who was big with the ISE in his later years and just passed away. I think he's the guy they credit with bringing around puts and actually helping to create that product. Yeah, they decided very quickly on after a few years they need something else to express. The call itself doesn't express all of the viewpoints. And think about it, listeners. If you're out there, if you have a stock and you're worried about it, you could sell a call against it, sure, but what's that going to do for you? Unless you sell some really, really meaty call, you're only going to get a little bit of a cushion to the downside, and that's about it. Like we were talking about with Shake Shack. You sell a call, well, that's not really going to help you too much if the stock goes from 76 to 35. A put could. And so they quickly realized that they needed extra instruments. Anyway, what's your take here, Uncle Mike, on what's going on in the land of Mr. Calls versus puts?
Yeah, I remember just doing events at the SIBO many years ago and just talking to some of the old-time traders that were around before the invention of the put. And a lot of the consensus was that really hurt a lot of the floor traders because of the way with which they could set up trades. Since puts didn't exist, they felt that they were at an advantage because of the fact that they knew how to hedge and work in an environment that only calls existed. And they were able to make money on floats and just do a lot of different things on it. It was a very interesting concept. So I agree. If you really want that, then work with stocks or futures. If you want to just do one thing or the other, you can do that. The other thing that I would recommend doing just for general education is just go to cboe.com or learn from or contact Sebastian or in some way, shape, or form, learn about option synthetics. Really get a good view and a good learning really get a good education on how being long stock, long put is the same thing as being long a call. How a covered call is the same thing as a short put. I think that'll help give you an understanding of it as well, so you can learn why you would do different things. Because once you learn that, I think that that's a huge part of the learning curve when doing this fun thing we call options.
Indubitably, sir. Let's see. Let's wrap it up here. Going to a little bit shorter show today, listeners. I have to run, unfortunately, but let's wrap it up here with kind of the eternal question. This one comes from George's S, or just George S. Maybe the S is silent. You never know with some of our international listeners. He writes, "Why are iron condors so popular? Seems like many other strategies can offer similar performance. Why has that one strategy become so dominant?" That's a good question, George's. I've kind of wondered that myself a lot over the years. It seems like it has tapered off a little bit now, but in the early years when we launched Insider back in 2007, 08, iron condors were the strategy du jour. You had a myriad of different newsletters and services out there hawking, writing iron condors. We, of course, have done a lot of stuff with Jared Woodard, who ran condor options for a long time. He himself has even moved on from that now. So it seems like maybe some of the bloom has come off the iron condor rose, but they still are a very popular strategy, particularly on the short premium side. And I think what it is just it allows you to express a little bit of that viewpoint, sell some stuff, get a little bit close to the fire, but not so close like with an iron fly or even a butterfly, where you're selling a lot of the meaty strike, where the actual at the money strike, where the fire is, where the danger is. You're selling it a little bit farther away, so you can kind of maybe say to yourself in your heart of hearts, well, you know what, it probably has a decent chance of not making it to that strike. And lo and behold, if the worst does come to pass, you're buying a little bit more insurance out of the money. So the insurance isn't that expensive. You're selling something close, so you're collecting a credit for it, but it's not so close like an iron fly, where you really are kind of maybe biting your nails if you're a little bit more risk averse. So I can probably see why people have migrated to that. Maybe they start with the flies, they look at them and they say, wait a minute, I'm uncomfortable with this amount of theta, with this amount of gamma, and all the other things that are going on here. Maybe I'm going to give myself a little bit of a break. Let's migrate it back a little bit from the at the money so I can sleep a little bit at night, and hence the love for the iron condor. Uncle Mike, where do you fall once again in the great iron condor versus iron fly debate? And what do you have to say here for our friend Mr. George/Georges on why you think they're so popular?
Well, a couple things. In terms of iron condors versus iron flies, I think it's whatever the market's giving you. There's a time that condor is better than a fly, and then a fly is better than a condor, just depending on how volatility lines up. Typically, I would say I prefer the iron fly. I'd rather risk less money and do an iron fly and get the same amount of return as doing. I can do a 1-lot iron fly to generate the same income as I could do getting a 10-lot iron condor, especially if you're comparing it to one that's way out of the money. I have to be a little bit more active, though. But nonetheless, 2004 to 2007 was the golden age of the iron condor. I remember traveling the country, and I couldn't even tell you how many people would say to me, Mike, well, how come how come the whole world just doesn't do iron condors? I mean, what are the odds of the market actually moving 8% in a month? And well, obviously we all know how that movie ended in 08, 09. That's when they all lost all their money. So with that, I think the reason that people are so attracted to them is this is the life cycle of a beginning option trader a lot of times. They learn by just buying a call or buying a put. Now, granted, it's a neat idea. You don't risk a lot of money, but a lot of times that they lose. And losing gives you a poor feeling about trading. However, after you're educating yourself while going through this and learning a little bit more, you realize, oh, this iron condor out here makes money 90% of the time. And on a call or a put, you realize that you can lose by both time decay as well as the market moving against you. You're thinking, well, wait a second, 90% sure sounds nice to me. And then all of a sudden you realize that 90%, even though you heard 90% and you say 90%, the selective hearing that we all have as humans tells us 100%. And then things go well for the first couple of months. Now you're getting good feelings, and the endorphins are coming into your brain left and right. You feel good about yourself because of the fact that the first 2 or 3 months, you're doing really well. You're making 5% a month or whatever. And the best part of it is that's very low maintenance. The market only moved 100 points in the Dow today. I don't care. And it has to move another 1,000 before it touches my short strike price. This is easy money. And you have this wonderful feeling. You feel like this powerful capitalist who just solved so many financial problems, not only of you, but of anyone else that you come into contact with who asks you what you're doing for that. So with all that being said, an iron condor is something that gives people great feelings. It's high probability. Who wouldn't want high probability in this low probability world? But then the morning comes. Then the hangover hits. Then all of a sudden, you actually have one that starts to go against you. You're short the 55-60 call spread, let's say, and now all of a sudden, the underlying is up at 54.95. Oh, crap. This is why I got into this iron condor stuff in the first place. I hate this feeling. Now I have all the bad feelings that I had of when I was buying and selling calls and puts. I hate this. Why am I doing this? And then you feel horrible. You then feel embarrassed because of the fact that you told all your friends about how this wonderful iron condor is. And then all the emotions come running against you. And then all of a sudden the stock goes your way again. It goes down. It's back at 53. Oh, it's all better now. I knew I could have faith in the iron condor, and you live to trade another month with a profit. But then the next month, stock, you have the same strike prices on your condor, stock goes to 75, you're blown out, and you're just another victim. Option trading's horrible. I should have never gotten into it. That's the life cycle of a foolish iron condor trader. Avoid it, listeners. Avoid it. If you're going to trade iron condors, plan on managing risk the entire time.
Spoken from a man who has been burned or have had a few clients perhaps playing a little bit too close to the fire with some short iron condor, sounds like, sir.
I've avoided them just from the experience that I saw in 08-09, just from all the myriads of people that I met that blew out their accounts.
Yeah, that certainly would be a poor year to be writing a lot of premium, regardless of the strategy you were utilizing. Interesting stuff. Unfortunately, that's all the time we have for that, listeners. And now we're going to keep on rolling right on into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody. Welcome to Around the Block. Going to do a truncated one here, Uncle Mike. So we're going to do a combo of what you're watching for the rest of this week, as well as what's coming down the pike in the land of RCM MISC. So what are you watching and what's coming down the pike for our listeners, sir?
Watching the calendar, actually. We're heading into June and just curious to see if the summer doldrums come into effect a little bit early. We're right at the all-time highs right now, or just below them in the S&P, so curious to see how that comes about. Bonds have been relatively quiet lately, so and by lately I mean the last few days, so looking to see if we get any action in anything anytime soon. In terms of what's coming on in the near term at RCM, I am once again calling all hedge funds that have assets under management of between $1 and $5 million, or if you're just a private investor and you have assets between $1 and $5 million, and that's your trading account. At RCM, we have over $100 million of assets under management, so we get a very beneficial commission rate through both TD Ameritrade as well as Interactive Brokers. We will share that with you for a small fee, and we're very workable in terms of making it so it's win-win. And we provide advice as well, should you want it or need it. Give me a call if that's something with which you're interested in at 312-212-3531, or send me an email at mtusaw@rcmfs.com.
All right, listeners, take them up on that. It's a good deal if you are so inclined. And on behalf of Uncle Mike, and indeed even the folks over there at the pit who couldn't make it today, they were on assignment. I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming, and we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.